name is Andy Creech, team manager with Listed Issuer Services with the TSX Venture Exchange. And I'll be touching, I'll be touching on mergers and acquisitions as John and Erez had originally approached me to talk about that, but I'll also be talking about policy changes by the exchange and also some general market activity. So just disclaimer we need to do for our in-house purposes, but don't take anything I say today as investment advice, and please don't use whatever I say today as something against me in a pre-file meeting if you're coming in. So basically 5 broad topics: overview the financing activity, merger and activity on the TSX Venture by mining issuers, recent policy amendments, and then CPC and combinations and a few examples of those. So for the financing, this slide showed up better. You can't see that column. Anyway, there's 5 rows there, and the top row is the number of issuers on the TSX and TSX Venture Exchange, and it's approximately 1,670 issuers. The other markets combined, the London, AIM, ASX, Johannesburg, Hong Kong, and NYSE, aggregate about 1,000. So there's a fair bit of mining issuers on the Venture Exchange and TSX. In terms of market cap, TSX-V and TSX combined is approximately 400. Unfortunately, you can't see the numbers there, but basically 400 holds up relatively well compared to the other exchanges. They're all around about 400. The NYSE is about 1,000, or yeah, I guess it would be 1 trillion. And then the bottom 3 rows there, the top one is, top one is the number of new listings by mining issuers in 2012. So there was 137 mining issuers listed on the TSX and TSX Venture, and that is approximately 2 times as many as listed by all the other exchanges in 2012. The second from the bottom is the, I believe it's the market, no, it's the actually equity capital raised. So there was 10 billion raised in total, 2.8 on the Venture Exchange. And that, again, is about 2.5 times the other exchanges combined for mining issuers. And the bottom row there being 1,700, that's the number of financings. And not just coincidentally, it's 2.5 times larger than the other exchanges as well. So it ties in with the dollar amounts being raised. So to break down those financings, the average financing size was approximately $1.9 million for venture mining issuers, which actually sounded pretty high to me when I saw this slide. I lifted it from a BD presentation. But the second column there is the median. The median would fall in the second column, which is basically $500,000 to $1 million for the average financing raise. And that's generally more what I see come across my desk in conjunction with listings or financings filed with us. So this chart is a chart of quarterly new listings on the TSX and TSX Venture Exchange. I apologize for the slide. It should have shown up better. I'm not exactly sure why it's coming through, but I can just walk you through it. Effectively, red one's TSX new listings, green one's TSX Venture by quarter. And some of the observations I take from this is basically it starts there, hits a bit of a trough in well, not a bit, but it hits a big trough in 2008, 2009. Then we get the highs in the high 30s, low 40s in 2010, 2011. It's obviously dropped off down, but I'm encouraged to see a slight uptick anyway in the last Q1 and Q2 of 2013 as far as new listings going on the Venture Exchange. And as these two combined are 38 issuers, it does outdo the Q1 and Q2 2009. So we are down, we are in a trough, but it's not as low as there, and hopefully there's some sign of encouragement that potentially we'll get some more increase for Q3. So of those 38 issuers that we listed in 2013, I just thought it'd be interesting to go through where those companies are coming from. So basically for North America, there were 25 new listings, and there's a whole host of assets that were listed. There's gold, silver, copper, tungsten, beryllium, titanium. Those are the main mineral properties and types of resources that were listed in North America. 6 of the companies are broken out here. In South America, there was, I believe, 7 or 8, and principally it was gold, copper, and uranium from South America. Africa, no surprise, it was gold and diamonds, and there was about 4 companies there. Europe had 2, and that was gold, copper, and uranium. And Australia, that was basically one gold company there. Okay, so for mergers and acquisitions, basically, why are we seeing the companies merge? The 2 main reasons that I see companies coming in for pre-filings with to talk about mergers and amalgamations are: 1, you either have a company with a good asset and no cash merging with a company with cash or access to cash, or 2, companies coming together that are joint venture partners and have diluted interest in the property, but if they can combine and get 100% interest in the property, potentially they could finance that property or project better. As far as the activity, year to date, there's been 34 in 2013. So that puts us on a prorated basis for on track for about 55 merger activities that are not RTO or qualifying transaction mergers. And that's in between 2012 and 2011, there was 50 and 59. So it's basically right on par for the average there. When I was going through the bulletins, compiling those numbers, the 34 in 2013, they basically broke down as 2 were for shares for cash. Obviously the overwhelming favorite was shares for shares, companies trying to preserve their cash balance. 3 were shares for a mixture of cash and shares, and then 3 were optional, so the shareholders could pick from taking either all cash, all shares, or a mixture of the both. So when companies do enter into mergers and amalgamations, and what are the filing requirements with the exchange? They're basically subject to our policy 5.3, section 8, and it basically outlines that the company has to issue a news release, do a letter filing with us, and one of the keys we look at is the amalgamation ratio. Look at the amalgamation ratio and basically the fairness of it. So we're looking at the fairness opinion as well. In certain circumstances, you need to get a valuation done, and that's usually when it's a related party merger, unless there's some sort of exemption under 61-101. This section of policy, I should note, doesn't apply to COBs or RTOs or QTs. That's subject to a different policy together, but effectively when 2 companies are simply merging, that would be that. So there's a geological report prepared for the assets subject to the transaction, and then there's a disclosure document distributed to shareholders and shareholder approval obtained. So I'm sure all of you, when the sun was out in August, were waiting with bated breath, monitoring our TSX website to see what sort of recent policy changes we'd come up with. But in case you missed our riveting announcements from August, there were 2. And one was on August 7th, 2013. It dealt with changing to our pricing limits. And one was on August 14th, and that dealt with the lapsing of temporary relief measures and founder shares guidance, and the implementation of some new permanent policies as well. So what we did change is, from a policy perspective, is we had temporary relief pricing out there, which was a relief for certain minimum pricing requirements, and that was in effect from August 2012 to August 2013, which allowed issuers to finance at below a nickel, basically. The whole temporary relief policy was rescinded and replaced with some more permanent policy changes. There are still some issuers out there, and some of you in the room may have some financings in underneath the temporary relief measures, so I would encourage you, the deadline for getting those filed with us is, the final materials is for September 30th, so that's next Monday, so if you haven't already done so, please ensure you get that in. And then we came up with new permanent policy changes. Basically, we reduced the exercise price for warrants and stock options and convertible debentures, and also changed the price for IPOs. We also then eliminated the exchange's requirement for shareholder approval on certain share consolidations. So what are these new prices that we did? Top line is private placement financings. I left that in. There's been no change on that price, but there's so many filed with us. Just thought I'd make that clear. It's still a minimum price of 5 cents. IPO financings, that's decreased from 15 cents down to 10 cents. Stock options, that's changed from 10 cents down to 5 cents. Warrant exercise, similarly, that's gone from 10 cents down to 5 cents. And convertible debentures, that's changed from a minimum price of 10 cents in the first year down to 5 cents. And And then after the first year, it ratchets back up to 10 cents for a minimum conversion price. So just to follow up on the consolidation, as I had said, specifically what we did is we removed the exchange requirement for shareholder approval for consolidations for up to a 10-to-1 consolidation in any 24-month period. Now, issuers may still, even though we've removed our requirement for that kind of consolidation, it depends what corporate law applies to where you incorporated your company. You may still be subject to shareholder approval for a consolidation, even for a 2-for-1 consolidation, depending on the corporate law applicable to the issuer. Effectively, what this could do is in some jurisdictions, and my understanding is BC incorporated issuers, I could be wrong on that, but they can effectively implement a share consolidation with a director's resolution as opposed to having to go to shareholder approvals as they had to previously. Convertible debt, briefly talked about that before. Basically, the pricing below 10 cents, we allow that now on a permanent basis for the first year. After that, it ratchets up to 10 cents for the balance of the term of the convertible security. Founder shares is, not sure if all of you are aware of that or not, but basically founder shares is the exchange way of saying shares issued at less than 5 cents per share. We had hard cap guidance out there for mining issuers saying that you couldn't issue more than 15% of a listed issuer's shares that below 5 cents per share. And that created some issues for potential listings with us. And in large part that came in because back in 2010, 2011, pretty much any project out there was getting financed and basically blind money was getting thrown behind it. And some of these share structures seemed overly dilutive. So we brought in the founder share guidance, but now we're basically rescinding the founder share guidance to say, okay, well, if a company can these days finance their project, why are we going to get in there and stop that? So my only advice is if you are proposing a new listing on the exchange and you do have share structure with more than 15% of your shares issued at less than 5 cents, to come in for a pre-file meeting so we can go over the share structure with you and hopefully address any items up front to basically speed the process down the road for you. Okay, so CPC combinations. First off, hopefully I'm guessing some of you in the room are CPC founders and are familiar with the term, but basically for those of you that aren't familiar with it, Capital Pool Company is basically a company that is newly incorporated, goes through an initial public offering, and it's a shell company with a strong board of directors that has some cash tied to it. Probably, on average, I see between $300,000 and $500,000 being raised by the Capital Pool Company to go out and look for an acquisition. They're either looking to buy a bucket of assets or a target company, and when they do make that acquisition, that's called a quote-unquote qualifying transaction. Part of the CPC program is to complete a qualifying transaction with 24 months, and we do have a fair bit of CPCs out there right now looking to do a qualifying transaction, but maybe aren't able to do so by their 24-month deadline. So there is a list there, and there's approximately 85 CPCs available to do a qualifying transaction at this point, and there's more on our NEX board that have gone past their 24-month deadline, but there are CPCs out there. And one of the things that CPCs can do, and focusing back on mergers and amalgamations, is there's two options to help a CPC do a qualifying transaction, and one of which at the top is to combine with another CPC. So it means that they haven't done a quote-unquote qualifying transaction because they haven't bought any acquisitions, but two CPCs can merge and reset their clock to do a qualifying transaction from an additional 12 months. The other thing a CPC can do as part of a qualifying transaction and effectively wind up is take the cash that they have on hand and roll it into an existing public issuer via a private placement. We're starting to see more of these happen because these issuers are coming up to their 24-month deadline. And if they don't do a qualifying transaction by the 24-month period, the founders of that CPC get some of their seed stock carved back. So as an initiative for those founders, they're either consolidating CPCs to cut down on the overhead for each CPC being out there so they can focus on a deal on a combined basis, or they're winding up the funds and treasury into an existing issuer that they think is low valued right now. The process for both of those is for a CPC combination and a public company transaction. Is the share exchange is usually based on the working capital available in the CPC. And the good news is there's no sponsorship required for these type of transactions, so the brokers don't have to be involved for charging corporate administration fee for that, and which preserves the cash for the issuer. There is a restriction for pro group ownership in the resulting issuer. As long as that stays below 20%, then the merger can go forward. And shareholder approval for both the CPC combination or private placement by CPC into an existing issuer is still required. So some recent examples of these mergers happening is Folkestone Capital and Sophia Capital merged together. One was about 2 weeks away from its 24-month deadline. This merger reset the clock to do a qualifying transaction for an additional 12 months, so the founders get to keep their seed stock. And the other one is a private placement into an existing TSX-V issuer, TSX issuer. Penfold Capital, they did a private placement into a TSX issuer, and the bottom two did private placements into a TSX venture issuers. And contact information's up there. I've included some contact information for our global mining person, Orly, on the left side, and Carlos on the far right side for TSX contact information as well. The individuals in the middle there are regional heads for Vancouver, Calgary, Toronto, Montreal, in case you have questions for those jurisdictions as well. That's it. Thanks.